The topic for today is the rise of Bitcoin yields. This is an area we've been working closely adding to the block and an area that has expanded significantly over the past few months. So we're eager to dive into the subject. First, we'll start by looking at Bitcoin's involvement within DeFi since before 2020. Then Bitcoin restaking, which is the new opportunity that has arisen. And finally, discussing the path ahead and what can come out of this. Before we get started, quick update about Into the Block. So our Perspectives product launched 2 dashboards in preparation for this webinar, and it's again an area that we've been focusing on. So we updated our coverage of the tokens in Bitcoin and DeFi to include CBBTC and a lot of the new Bitcoin staking tokens. And then we also added this new dashboard on Stake Bitcoin, which covers the Babylon ecosystem, as well as Symbiotic, which has Bitcoin staking on Ethereum. We'll discuss both of these dashboards in a lot more depth throughout the webinar. Finally, on an unrelated note, we also launched the Kelp Risk Radar dashboard and are soon to launch it for Swell. So this is for eigenlayer restaking protocols, and we're looking to do similar dashboards for the Bitcoin restaking ecosystem as well. So first, let's get started by going back to the origins of Bitcoin. I have this quote here. I won't read it from Satoshi in the white paper that always criticized the weaknesses of the trust-based model for commerce and like finance. So it was pretty clear from the initial vision that Bitcoin was set to be a peer-to-peer cash, but that the idea was to have an ecosystem around it throughout trustless finance. And so there was a lot of discourse on this in the first few years of Bitcoin. That eventually led to the creation of some separate L1s. Most of these were forks of Bitcoin, trying to create applications. I believe BitShares, for instance, was tokenizing assets back in 2014. This proved to be too early, but it's clear that the idea of open finance was really, since the get-go, part of Bitcoin's vision. And it started to come into fruition with the launch of Ethereum, which was the first Turing-complete blockchain. And eventually, we started seeing applications on top, and tokenization began to thrive. So that was in 2015 to 2018. And in 2018, as the first few dApps started going live, like MakerDAO, Kyber, and a couple more, the BitGo team proposed the launch of Wrapped Bitcoin. So it was introduced through a blog in Q4 and launched in January 2019. This was essentially thought out as initially as similar to stablecoins, where they're essentially importing an asset that it lives elsewhere outside of Ethereum. Just like dollars live in the traditional finance system and are imported into Ethereum. And the idea was to get something that was tied one-to-one to it and be able to benefit from integrations within the DeFi ecosystem. So this was still very early, an immature ecosystem in 2019, but it was very proved to be visionary, I would say, in the sense that it allowed a lot more applications in the years that came after. And it grew from like 2019 to $500 million in market cap by September 2020. That's when we began covering it within Into the Block. In the after DeFi summer, so-called DeFi summer in summer 2020, a lot of us in the company were looking at Wrapped Bitcoin, and we were quite bullish on the concept. And that proved to be, again, also very timely. So not to toot our own horn too much, but it did grow from $500 million to over 20 billion in the next year. So in terms of Bitcoin, from 50,000 to nearly 300,000 BTC, but it's been quite cyclical. So unsurprisingly, the tide of tokenized Bitcoin is also very related to the amount of opportunities that you can access in DeFi. And so we see a spike here in March 2022 as Terra continued pushing, but right after it imploded, we see a crash in 2022, and then a lot larger crash in the Q3, Q4 2022 as Genesis and Alameda imploded. So that really took a 50% hit or so across the space. And we didn't see that recover basically at all until until 2024, where some DeFi yields started coming back to the market. In terms of the market share, even though it's a large number, still about 10 billion, in terms of the penetration of all Bitcoin, it's roughly just 1% of Bitcoin that has been tokenized. Most of it going to wrap Bitcoin, but there's also other alternatives. And we have seen, however, an uptrend over the last few months. So wrap BTC had a first mover advantage. It had over 90% of the market until 2024. We see BTCB on Avalanche has gotten some market share over time, and more recently, as Babylon really took place and people started looking for yields, Solve BTC and LBTC have gotten traction. And just over the past few weeks, CBBTC from Coinbase also has gotten about 500 million in market cap, I believe. So this has led to the wrap BTC share dropping below 70% for the first time. It's still the largest by far, but we're seeing increased competition. And we won't go into too much detail, but of course, wrap BTC is also in the process of being acquired by the company behind Tron. And so there is some uncertainty there that has prompted market participants to look at alternatives. And how is wrap BTC used? A pretty high amount of it is deployed in DeFi. So 60% of wrap BTC is deployed in DeFi. This is substantially larger than other tokens. And 75% of that is actually in lending protocols. So this is very clear that the main use case for tokenized Bitcoin is essentially getting leverage against your Bitcoin in protocols like Aave or Compound. And this leads us to the question of how do you get Bitcoin yields through DeFi? It's the main topic of the webinar and something that into the blog through our institutional product, we are able to productize this through smart contract strategies. And essentially there are two main ways until recently that you can get access to yields on DeFi, which are through leverage or loans, through fees from DEX trading and similar strategies. Incentives are tied into both of these that can help boost these yields. And as we'll get into towards the end, there's also now the introduction of native yield opportunities coming to the Bitcoin ecosystem. So this is an example of how you create a strategy that allows you to access leverage on Bitcoin. We call this a supervised loan strategy. We have some articles diving into it in our Medium, where essentially you have a first strategy we call an S1, where you supply BTC into a lending protocol such as Aave. You need to be aware of what collateral ratio you choose and what level of liquidation threshold is set by the market. And then you borrow another asset. That asset can be either ETH, stable coins, or in some cases even a more niche asset. And the idea is to allocate that into secondary strategy. We call it an S2, where that borrowed asset earns more yield being deployed than the cost of that leverage. So that's the inherent condition for this to make financial sense. And then, of course, being a leverage strategy, you risk being liquidated. And there are also independent risks within each protocol. We won't get into it in too much detail, but at Into the Block, we execute this in a programmatic manner, such that is if the value in your secondary strategy like that increases, we're able to automatically withdraw assets from the secondary strategy to repay debt. So if you're borrowing stablecoins, for example, against Bitcoin, and Bitcoin crashes, we have the ability to repay some of the debt from that stablecoin strategy, like withdraw capital and automatically repay that so that your health factor increases and you don't get liquidated. So it's a complex strategy, therefore why it's mostly focused on institutions, but it's worth keeping in mind. And a bit more simple strategy, though often less interesting, is just applying BTC tokens into DEX pools. So this can be either a pool with impermanent loss, such as a BTC ETH pool or BTC stablecoin pool. If Bitcoin goes up, you essentially end up with less Bitcoin, and so it creates this impermanent loss, as it's called. Or you could supply to a pool, for instance, like Wrap BTC, TBTC, where you don't have impermanent loss, but usually the fees are relatively low. So what you need to consider is that the fees and incentives are greater than your impermanent loss. And the risk to consider is impermanent loss from deviation of the assets, the depegging of BTC tokens, which has happened, though usually it's been quite brief. And there's protocol risks that could also play into making this more or less attractive. Now let's dive into the emerging Bitcoin staking ecosystem. I would say, even though they weren't the first to propose it, EigenLayer have been the pioneers throughout the shared security model. This has been discussed in other communities, such as the Cosmos community and a few more, but EigenLayer has been the first to really bring it to scale. And the idea is to have new applications or even existing ones to bootstrap their security using existing Ethereum security. So the framing is there's 30 billion plus being staked in Ethereum. What if you could use that security budget to bootstrap your own application rather than just spending, 10% of your token supply to help create staking incentives for new validators to operate in your ecosystem. So instead, an ecosystem of AVSs, actively validated services, just connect to the existing Ethereum security, and they issue a slightly higher yield, say 6% instead of 3%, and making it cheaper for them to access the liquidity, and also making it better for them to get distribution throughout the existing Ethereum ecosystem. That is the core concept that has been restaking, as it's called in Ethereum, that is being recreated in Babylon for Bitcoin staking. They just call it staking instead of restaking because there is no underlying staking on proof of work. And so the way Babylon works is essentially they connect the Babylon node to the Bitcoin L1. This, by the way, I should clarify, is not how it works at the moment. It's how the architecture is set to be working once it scales and it really launches. At the moment, it's still very early, so you only have the basics of it live. But the idea is any application or standalone chain can launch and leverage Babylon to get the security of Bitcoin, the decentralization, and the broader ecosystem reach, similar to EigenLayer, but for Bitcoin. And users can choose to either directly stake Bitcoin themselves to each application that they want to validate, or they do so through a liquid staking or liquid restaking token that effectively manages a portfolio of protocols that give you like a yield on your Bitcoin. Again, to clarify, this right now is deployed just as a farm, essentially, where you get points from Babylon and of the LRT tokens that give you future percentage of those tokens. But at the moment, the applications are not live yet. Within the LRT ecosystem, we're seeing Lombard pick up as the market leader. They did a large fundraise from Polychain and a few others. and they're effectively the equivalent of EtherFi or Kelp, but for Babylon. And compared to EtherFi and Kelp, they manage to deploy assets on Bitcoin. So they deploy to Babylon directly on the Bitcoin chain. And then they have a consortium of addresses that handle the delegation to Babylon and effectively allow you to connect to smart contracts on Ethereum, minting LBTC on Ethereum. So the process is multi-chain from the get-go. You deploy assets on Bitcoin and get LBTC on Ethereum. And this makes Babylon connected with existing Ethereum ecosystem, therefore being able to plug and play with protocols like Uniswap, Curve, Compound, etc. A process with which we've began to see over the last few months. And so as this has launched, Babylon launched in August, we've been seeing a lot of growth from the restaking ecosystem or staking. There's already 800 million in deployments, most of it, just over half, coming through LBTC. And then we're accelerating in the last few months as the caps in Babylon increase and the integrations across DeFi also expand. So one integration in particular that stands out is in Pendle, where you're effectively able to speculate on the yield that Babylon and similar projects will provide. So this is effectively a market betting on the price of Babylon. It's almost like a pre-market based on the distribution and of Babylon. And it creates the opportunity for large BTC holders. You know, if you don't want to speculate on how much those Babylon points will be, you can just get the fixed APY. So at the moment, for instance, with Solve BTC WBN, you can get 7.5% selling your points for fixed yield. And this essentially how the way it works is when it matures December 25th, you get the equivalent of 7.5% APY, so that your amount of tokens increase by the corresponding amount, and you forego the points. So someone else is buying the points from you and speculating in those throughout that time. So as I mentioned, we've been seeing a lot of growth. So on-chain volumes on Ethereum have surpassed over 100 million in multiple days already. And this is likely to continue accelerating as the market catches on this. So this is on a logarithmic axis, and it's still looking like very steady growth in that, which really relates to exponential growth here. It's still relatively small. So this percentage of Bitcoin that is staked. So this is the ratio of wrapped Bitcoin that is staked. So all of the tokenized Bitcoin, the amount of staked Bitcoin makes up about 5%. That is climbing quickly. So it is very likely this will hit 20% based on our projections as people look for yields on Bitcoin. And there's also cyclical demand. So similar to how tokenized BTC grew significantly in 2020 and 2021, you know, as the market has picked up the last few weeks and seems primed to continue growing, it's very likely that the demand for people to want to get access to these Bitcoin yields is only likely to continue accelerating. And I think this is going to accelerate even further once there is integrations within lending protocols. I think there's a few and small lending protocols, but there's a couple major integrations coming that will really accelerate this growth. So essentially, this will create the options for leverage staking Bitcoin coming soon. So a leverage staking strategy has been popularized through Lido staked ETH, where you deposit staked ETH, borrow ETH, and the ETH you borrow, you resupply to staked ETH, or even swap if it's a small discount, and loop that. So you are essentially getting your long the staking yield, while you're short the borrow cost. And so as long as your stake BTC earns more than the cost of borrowing the BTC, this could work at scale. At the moment, borrowing BTC on Aave costs about 1% or so. And as I showed on Pendle, the staking yield is projected to be like 7%. So that's a very large margin of difference between one and the other. So plenty of alpha to be extracted as lending markets enable that, because you would get about a 6% spread and you can loop that multiple times. Protocols are still evaluating this, like the larger lending protocols like Aave will probably take a few months to deploy this. But in the meantime, Morpho, Euler, a few of these more middle ground protocols will likely be offering this soon. And the risks to follow here are the risk of liquidation. So if the BTC tokens depeg, or if they get exploited, even worse, you could get liquidated, potentially losing a portion of the BTC that you supply. And there's also independent risks, if a lending protocol gets exploited, or some of these LRTs or Babylon, of course. So these are all very new protocols, but they should be creating some attractive yields over the foreseeable future. And that leads us to the last section of the webinar. What's the potential path ahead for Bitcoin yields? In my opinion, again, this is nothing like have to do with Into the Blocks opinion as a company, but rather everything from my personal point of view. It seems like we're sort of running it back, as people say. The Eigenlayer playbook, it's been extended to Babylon. This is the Eigenlayer TVL measured in ETH. They are making their token transferable today. So it will actually be very valuable to see how it reacts, the TVL, and how the token is priced, to get an idea of the potential market for Babylon. Again, they're the pioneers in this topic, and in my opinion, Babylon is sort of extending this to Bitcoin for the time being. And so for the foreseeable future, so the next 6 months or so, we're probably in like this area for Babylon, where we already experienced significant growth, from 0 to 800 million in assets. And the next quarter or two, I would say the growth really accelerates, especially the market picks up for Babylon. If the market picks up in general, we'd like to see more demand for Babylon. And there's also an ecosystem of layer 2s looking to leverage Babylon. So that will make it more integrated across DeFi and within the existing Bitcoin L2s. So that will be the roadmap for the next, Q4, Q1 of 2025. We're likely to just see points farming accelerate as more integrations happen. And then towards the second half of 2025, I would expect the first products. They call them AVSs in Eigenlayer. I think they're slightly different in Babylon, but really the first few applications that launch spinning up the Babylon architecture will only happen towards the end of next year. So we're unlikely to see, the real substance of it until the longer term, but we should be able to get some yields in the meantime for people that want to speculate on the future potential of it, which, could be quite interesting. So overall, I think this will make Bitcoin and the Ethereum world converge even further. So since the Taproot upgrade, we see Bitcoin being more programmable, and there's people finding ways to create new tokens on Bitcoin through runes, through ordinals before that. So I think there's a growing trend towards making Bitcoin more useful, and Bitcoin staking fits right under that trend. L2s are becoming more viable with Bitcoin VM, BitVM. So there is a lot of effort to making, solving the issues from Lightning Network and making it actually scalable for people to use and not only transact Bitcoin, but also integrate it across a universe of applications. So by the late 2025 to the rest of the decade, I think Bitcoin will have a more similar ecosystem to the one on Ethereum, while also connecting with the existing ecosystem. So will probably be more of a bridge initially as it is now, but later on we'll see more native Bitcoin applications deployed directly in Babylon. And long term, this creates more sustainability for Bitcoin as people pay fees to move Bitcoin from one chain in Babylon to another and to transact. So it makes it more sustainable as miners earn less and less revenue every halving. So I think this is a long term a positive trend for Bitcoin and should make it a lot more compelling as well for people looking to get yields on their Bitcoin. So to conclude, tokenized Bitcoin is already creating a lot of opportunities for holders and to gain yield. Right now, these are mostly on Ethereum and has been the case since 2020, but increasingly so, for more Bitcoin-oriented people, they can also be accessible directly on the Bitcoin chain. So right now, we're seeing those ecosystems develop in parallel. And long term, there's an ecosystem arising that should really materialize over the next few years and make it beneficial both for the Bitcoin ecosystem and for people looking to get yields on their Bitcoin. That's it for today. Thanks everyone for tuning in. The next webinar will be on the next generation of L2s. So we're evaluating a lot of the novel concepts being launched, multiple different types of virtual machines incorporated into L2s, data availability being spun up separately. There's a lot of innovation here that we want to get into, so make sure to sign up. And with that, I'll wrap it up for questions.